You're listening to REIA Radio, the nationally trusted name in real estate investing. We dig deep to discover investors' why in real estate. If you want to skip all the BS and get in investors' heads, you're in the right spot. Be one of the thousands to check out REIARadio.com.
You don't have to do the cost seg in the first year of ownership. You can do a cost seg at any point, right? Which means if you bought a property 5 years ago, you can do the cost seg now and take that for this year's taxes. The other important thing is that even if you have something listed for sale, if you didn't yet file your taxes for 2024, you can still do the cost seg and get this tax deductions for 2024. However, right, you're going to have that recapture tax right on the sale the next year. So it's a question of, always the strategy. Do I have a big tax bill this year that I want to offset? And what's going to be my situation next year? And again, to discuss that with your CPA and figure out what the best strategy for you is.
This episode is brought to you by Timber Creek Virtual.
At Timber Creek Virtual, we don't just keep your business running. We take it to the next level. Our virtual and executive assistants handle all the everyday tasks so you can focus on what really matters, growing your business. Need clarity on your financial performance? Our expert bookkeeping services keep everything organized, so you always know where your business stands. With our seamless transaction coordination, you never have to worry about the details. Just close the deal. We've got you covered with cutting-edge digital marketing, proactive lead generation, and expert acquisition management. Plus, we handle the cold calling and messaging too. Let us handle the big C work so you can handle your business. Visit timbercreekvirtual.com/services and see how we can make your business soar.
Welcome to REIA Radio, episode 166 with Yonah Weiss.
Yonah, thanks a lot for telling us right before we hit record that this is by far the favorite podcast out of the 500 plus that you've done. Really appreciate that. It's too bad we didn't get that recorded.
But that 5-star you gave us was really cool. So thanks for doing that, man.
Love it. You guys are awesome. I love the energy. And, I wish I was there in the studio with you guys. That's the truth. Not just because of the bourbon, but because, just the energy in person, it would be a lot better.
Well, that's what we're good at, is bringing the energy. All the rest, maybe. We rely on the guests to bail us out of our awkward conversations that we get into. But thanks for joining us, man. This is going to be a lot of fun. I have met you personally virtually personally, a couple of times now, and you have helped out on a couple of cost segregation studies that I've done with two different business partner groups. So thanks, and nice to see you again. This is pretty cool.
But how did you guys get connected?
He is the king of cost seg.
Well, I know that.
I don't know if you knew that,
but I want to know how you specifically got connected to him. Like, how did you already hear about him prior to this?
I asked around, and I heard his name more than anybody else that I had ever heard. But before that, and this is one question I had for you, Jonas. Actually, I did a little bit of following of your account on Bigger Pockets for a long time, actually. And I would see that you started posting about, taxes and cost segregations and how they can be helpful for investors. And you started getting more and more people reaching out and asking. And you had these huge forum posts because everybody just kept jumping on that, and they would get keyword searches that would hit it. Right. So do you think Bigger Pockets was a big, portion of maybe your success in being known as the world's top cost seg expert?
I definitely think it contributed to it. At the beginning, when I started working the cost seg, and I came in working in business development, and I found immediately that the number one thing to sell, as a business director, to sell cost seg is education. People literally just didn't know what it was. I asked everyone that I knew, and no one knows. So I found, Bigger Pockets. I was a member before because I had done some real estate investing. I had done some other things in real estate prior to starting the cost seg business, and knew it as a great forum. And yes, I started answering questions. That's what it was. And the amazing thing about Bigger Pockets is that it's there. The forums are there ad infinitum, meaning it stays up there, and people do a Google search. You'll get a post from 2017 or something. And it's amazing because it's always there. And so you can search the keywords, really hit it. So Bigger Pockets when I started out, I was using that forum a tremendous amount. I haven't, to be honest, the past couple of years, haven't really spent much time on that forum. But I've through BiggerPockets and then started with LinkedIn and other social media avenues, I've found tremendous success. Yeah. So BiggerPockets had the networking that came through that, the clients, accountants, and things like that I've connected with that has definitely helped draw a tremendous amount of business.
Yeah, that is funny too, but it's the downside of the, internet existing in perpetuity is you can go back and look at your own early posts that you had. And I've done that a couple of times, and wow, that is really embarrassing.
Was it bad advice?
No, it's just like the questions that you ask, because you go from originally when you find a place like that, it's a lot of times because you're looking for answers about stuff. And you just want to ask people questions that are more experienced than you.
Right.
And then after a while, you start answering questions because you start seeing the same answers and you learn and grow and so forth. And then, after a while, you look back on some of those and you're like, oh, man, that's a real facepalm moment.
It's like listening to the Dave Ramsey show and you're like answering all the questions before Dave Ramsey answers them.
There you go. Yeah, yeah, exactly. Now, we're going to obviously spend a little bit of time talking about cost segregation studies since we have, we have a captive audience here. But I noticed one thing on your LinkedIn profile that kind of stood out to me that I wanted to ask you about. So Block Crowd Financial Group.
Oh boy.
It looked like you did a stint at this company for just under 2 years. Is that right?
More of an advisory position. Basically, a friend of mine, a good friend of mine for years and years ago, started this company, and he knew that I had a huge network in the real estate world, and basically asked me to come on as an advisor in the real estate and kind of marketing capacity. So I didn't really do much, to be in all honesty. So, it's on there on the profile. I did some marketing for them. I gave some advice. I had, kind of like a weekly or, bi-weekly kind of meeting with the other people but it was unfortunately a failed venture of that friend. It never took off. And so I kept it up on the profile. I'm not sure why, but
for conversations like this.
Exactly. It was funny because I really literally knew nothing about blockchain and about cryptocurrency and all that kind of stuff before that. And this friend of mine, very successful person, in the IT world as a CTO for some very, very big companies, and started this thing off the ground. I was like, he was gung ho, all the way. He wanted to change the world with this. But I don't think anything ever really came of it.
Do you think at any point in the near future, we are going to have tokenized or fractionalized real estate that we could actually go to the store and I could sell like a 0.01% of my apartment building to buy some groceries?
I mean, it exists already to a very small extent. People have, tokenized and done that with some apartment buildings and things like that. It's not widespread whatsoever. If it's going to take off and to the extent that you're talking about, I don't know. I mean, it's all speculation. I don't think so, to be honest.
Yeah, that would be a weird world, man. You're just walking around seeing people and they're like, oh, hey, man, yeah, I got a piece of your apartment building last week. And you're like, what? Yeah, I bought it from Joe, the car dealer you went to. Wouldn't that be hilarious?
Vegas would own all the real estate.
Oh man, you're probably right. People, yes, I didn't even think about that part, but we just got back from Vegas, so I just had to call that out because it was such an outlier from the rest of your background. You had teaching and all these cost segregation things, and then all of a sudden, over here, blockchain and crypto. So fun experiment. Moved on from there. Got it. At what point was the Weiss Advice, which is your popular podcast? You've done, what'd you say, 400 and how many episodes now?
We just released today 420.
420. That's impressive. That takes a lot of stick-to-itiveness.
They must be doing like 5 a week or something like that.
Yeah. They're all 1-minute episodes.
Right.
We would have a lot if that was the case. But what was that like getting your podcast started, and how did you decide to do that?
So after having been a guest on well over 100 podcasts, and I was like, I love this format. I really love these conversations, and realized the benefit that I was getting just from being a guest on the podcasts. And I decided, hey, I should start my own because I have so many amazing people in my network that I'd love to interview as well. and we talk about real estate. It's not a podcast about cost segregation, which is funny. A lot of people do ask me that, like, oh, I want to listen to your podcast to learn more about cost seg. It's about real estate and it's about life. And really, I just interview the people that I know already and have, more in-depth conversation. I love to have you guys on the show as well down the line. But at a certain point, I was like, yeah, let's just, make it our own. And it literally took me over a year from the point when I decided I wanted to start a podcast until it actually launched Weiss Advice. And the main reason behind that, which in retrospect, I could have easily solved that problem, was I didn't have the who, the book, The Who Not How, right? I didn't have the people. It was like, I got to learn how to edit podcasts and I got to learn how to, do all this kind of stuff. And I didn't know anything about it. And it was literally through the network that I had that I reached out, and through social media posts and things like that, asking questions about how do you start a podcast? What do you do? What, this and that, and even helping people kind of figure out my logo and all. It was really fun using the community to help build it. And then when I hired a company to take care of all the back end and all the editing and everything like that, everything fell into place and I just launched.
Yeah, I tell you what, it's been really difficult finding a good producer of this podcast. We're still a work in progress.
Aiden's looking at us like
dead eyes. Kidding. We love you, Aiden. Now let's talk cost segregation. One thing that I did notice also in your background is you're a real estate investor yourself, or at least you were at one point. Are you still dabbling, still own some things?
Yeah, currently only as a passive investor. So I do have still several limited partner, positions in multifamily, self-storage, mobile home parks, RV parks, one retail property. So yeah, that's really the only thing. I kind of stopped doing the active side of things, but it definitely helps knowing more about the real estate world from the practical experience that you can really relate to the people you're talking to.
It reminds me a little bit of, when you meet these, I call them kids, like, in their early 20s or whatever, and they're starting out in financial services and they're like, oh, I'm a broker. And then, the common thing is like, oh, they're broker than you. So they don't have any investments of their own, but they're doling out all this financial advice, right? One thing that I liked about your background is you're actually eating your own cooking, and you're invested in a lot of different asset classes. Was the first cost segregation study you ever did your own, or for somebody else?
It was for other people. I didn't do any cost segs on any of my own personal properties at the beginning, because it was just, I had, single family, like fix and flips and stuff like that. It wasn't really relevant. And then in deals that I had done as partners, we did that, but that came a little bit later because I kind of put it on hold when I started working in the cost seg, and then got back into the passive investing a couple of years later. But yeah, I've done, which is an amazing thing. I've done the cost segs for many deals that I've been involved with, both as an active and passive investor. And it's amazing to see the results that come through. So I love that.
Is there any factors when it comes to living outside the country and investing in the U.S.? I mean, what do you gotta do differently than somebody that's, U.S. citizen? I mean,
there's not too much difference, not giving any financial advice over here, but, I hold a American, bank accounts and things like that, and, have American tax returns. So there is some, Israel, where I live, and the U.S. have a tax treaty. So you're not going to be doubly taxed and things like that, but you just have to make sure to set up the right entities when investing, so that you can make sure there's a blocker entity or something if you don't want to get, double taxed on certain things. It's not too complicated, but again, not financial advice, but just every country is different, and speak to your accountant or, attorneys for the right way to set things up.
I mean, we only talked to one person that was outside of the U.S., and that was Mark from Boostly.
Mm-hmm.
And he didn't have any properties here, so I've never been able to ask that question.
Oh, okay.
Well, Jeff Holst, technically 50% Costa Rica, isn't that where
but he's in states?
No, I know.
Yeah.
Now, I just think you have a cool background, man. You live in Jerusalem right now, and you operate through a company that is based out of New York City, and you've done a ton of these cost segregation studies. It might be helpful, and I know our listeners are skipping madly forward to find out what is a cost segregation study and why are they listening to this. Would you mind just giving a quick overview on, if it's not quick, that's fine too, but what is a cost segregation study? Why do people do them?
Sure. So cost seg, or as the cool kids call it, is a weird name for a tax strategy for real estate investors. So essentially, anytime you buy a property besides for your primary residence, whether it be a residential or commercial property, you're able to take a deduction from your income taxes called depreciation. Now, depreciation isn't what it sounds like. It sounds like something's going down in value. It's a negative thing. It's really just a borrowed term. It's the name of a tax deduction based on the principle that things go down in value. So you buy a property, you're literally able to write off the entire value of that property over a long period of time. So you're basically splitting it up over a 27.5 year period for residential properties, 39 for commercial. So that's what depreciation is. Essentially, you're taking a small deduction every year based on your purchase price on how much, the property is, so to speak, going down in value. Now, cost segregation is just a way of, it's an advanced form of depreciation, essentially segregating that cost, breaking down that purchase price into different categories and different components within the property that actually depreciate faster. So the IRS has given specific lifespans or useful lives to different components of a property. For example, personal property like furniture or fixtures, things like that depreciate over a 5-year schedule as opposed to that longer 27.5 year. So the cost segregation study, what it does, it's an engineering basically review of a property, breaking down from a construction engineering approach, breaking down the property into every little detail and showing how each detail has a different lifespan and adding those up and then getting essentially bigger deductions in the early years. So in short, cost segregation is a cash flow mechanism that allows you to take bigger deductions in the earlier years, taking that, essentially you have this pool of potential deductions that you can take, an equal amount over 27 years, or you can take from that, pull from that pool of deductions and take a big lump sum in the first year or the first few years. So you're accelerating some of those depreciation deductions, so to speak.
If I remember right, I think it was Congress that drug Henry Ford in front of them to basically ask him a lot of questions about Ford, and they were like, "How do you do this?" And he's like, "I don't know." "How do you do this?" "I don't know." He just said, "I don't know," over and over again, and they were exasperated with him. And they're like, "How do you operate one of the biggest companies in the country and you know nothing literally about how it operates?" He's like, "I don't need to know all of those things. I have people that know how to do all of those things. And if I need them, I will push a button and they'll either appear or I can talk to them and ask them whatever question comes up. And that's how I'm able to do this. I don't need to know it all. I just know the people that know how to do it. And my job is to steer the ship."
Right.
So I look at my knowledge of cost segregation studies as a very surface level, but then I look at, now that I know there's people out there that know this stuff so deeply that you can ask them literally any question you can think of and they probably know the answer. That's all you need. Yeah. As a real estate investor that is trying to take advantage of this. Basically, it's an offering that the IRS is giving you that says, and I want to know what your take on this is, Yonah. The IRS represents a collection of tax receipts from all of the citizens in the United States, right? They collect all that money and they disperse it into various programs that they were either voted in or they're off books or whatever, but they're doing things for the betterment of the country in theory.
Allegedly, right?
Yeah, allegedly. But the government does not want to own real estate for the purposes of owning investment real estate. Would you agree with that?
To a certain extent. Obviously, the government owns a tremendous amount of real estate in different, federal building and things like that. But yeah, I mean, the purpose of the tax code, and I think where you're going with this is, to incentivize people to do certain activities in certain businesses. And real estate is a huge industry in which investing in real estate is going to, help spur the economy in many, many ways. But like you're saying, just like the banks don't want to own property, right? Even though they're partial owners of almost every property in the country, they don't want to take it back. They don't want the properties, right? So they want to have maybe a piece of it or something, but they want the investors to succeed.
Yeah, I've just always thought that was an interesting. It's an interesting relationship that the government has with its taxpayers, and in essence, they're giving the IRS tax code to you and saying, this is what we want you to do. Here's what we're going to make you do, but this is also an instruction manual on here's how we're going to incentivize you to participate better in this economy. And I think it's interesting to see how people that are willing to put in the time and effort and education to learn what that playbook is incentivizing them to do, or others that are just like, that's for the rich. They're getting all the breaks. And it's like, it's literally spelled out for you in the tax code. I mean, granted, I've never read the tax code, but
right.
The point stands. It's like, there's all these, loopholes and instructions that everybody can use if they know how to use it. I just always found that fascinating. But would you mind taking a stab? And I know I didn't prep you for this, so I apologize, but can you maybe think of a cost segregation study recently that you've done and what it resulted in for the person that ordered that study from you guys? I don't know if that's a good question to ask or not, but it seems like it is.
Yeah, I mean, listen, and I can throw it back on you and say, hey, you did a cost seg. Like, what were your results? How did you fend from getting those done? Because I mean, we do thousands of these a year, so I could pull out any random one and kind of show. But it's amazing to me, and I actually would love to hear what you have to say about that. But just to kind of share, what amazes me the most is how people are using cost segregation to better themselves and better their lives, because there are certain rules in the tax code and certain people that can actually benefit from cost seg more than others. Because like I mentioned earlier, it is a real estate tax strategy. However, it's not for everyone. Just like, every strategy works better for some people, not as much for others. And so someone who is classified as what the IRS calls a real estate professional is able to use the maximum benefit of these deductions. And I've literally, had people who are, full-time real estate professionals and be able to pay, zero taxes whatsoever. And you talked about this, right? It's the incentive program, right? I remember years ago when Trump first came into office, there was a big article in the New York Times, headlines of the New York Times, like Jared Kushner, who was, Trump's son-in-law, who was, active in the government at that time, he, net worth of $300 million and hasn't paid any taxes, and that was the headline, right? And so you're meant to think, oh, the guy's, avoiding taxes. He's, a bad guy.
Yeah, he's like,
right?
Al Capone. That's what I mean. You know what I mean? He's committing tax fraud. That's implied.
Exactly. But and that's the headline. That's what they want people to imply, because most people don't read past the headlines.
Yeah.
If you read the article, it actually does talk about how he's using different tax incentives and 1031 exchanges and cost segregation and things like that. And he's legally not paying any taxes, not evasion, but legally doing it. And so the point is, real estate investors, yeah, you could be making millions of dollars and literally, have zero income tax liability. It's just about knowing the right thing. So one story I will tell very quickly, because I'd love to get back to you, Owen, hear how it's affected you personally, is of a couple that recently, is within the last year, that they went into short-term real estate investing, so Airbnb investing, which has become very popular over the past few years. Both of them were full-time professionals, doctors, and they were extremely busy, middle-aged, and they decided to get into short-term real estate investing through, there's a company called the Short Term Shop based out of Tennessee. And they're incredible people. Essentially what they did was they teach people how to self-manage their properties. And the reason why I'm bringing this up with short-term rentals, there's a specific rule in the tax code that if you own short-term rentals and self-manage them, then you can use those deductions from cost seg, from depreciation, to offset your active income as well, even without being a real estate professional. So without getting into too much detail there, important thing to note. They ended up buying 3 rentals over the period of about a year, and learned how to self-manage them, setting up systems and whatnot. And they were literally both able to retire within like less than 2 years, within 24 months. And they were making more money after taxes, because they weren't paying taxes essentially, than they had been, both of them working full time. And so that, to me, that's what this is all about. This is literally life-changing stuff. They were able to retire early in their 50s and basically running their properties, which they were able to expand and buy a few more since then, and literally making plenty of money to live off of, and only working a few hours a week, which is incredible, because self-managing short-term rentals, when you have the system set up, a lot of it's automated, and so there's not a lot to do there.
I've been learning a lot about that lately.
So I actually caught an episode you did with Amanda Hahn on the Short Term Shop podcast, I think with Avery Carl.
Yeah.
And I did not know that about short-term rentals. I learned that like a couple of days ago when I was catching up on this. So I was really impressed with that, and that was a fun episode because you guys dug it. It was I felt like you guys had a nice counterbalance to each other with her background as a the real estate tax professional, and then you being the cost seg king. That was cool. That was a good one. But I didn't know that about Airbnbs. Now I know you wanted me to kind of like maybe talk about my experience in walking through my first and second and third one of these with Madison Specs, which is your company, which I'm happy to do. But I never really thought about doing this for anything that this wasn't even on my radar up until very, very recently when it was maybe probably 4 years ago, I think I did my first one, and I had somebody tell me about it, and I was like, what? Like, I did what? How much?
That's everyone. Yeah, that's everyone's reaction. That's the amazing thing. That's literally like everyone's reaction. This can't be real. It's too good to be true. Or what? Yeah.
Now, the way I think about this in layman's terms, because I am very clearly a layman here, I think of depreciation, the tag that the IRS puts on real estate. So if you buy an investment real estate and residential real estate, it's 27.5 years. They basically take the entire property minus the land and say, if you bought this for $100,000, let's say the land was free, just for this conversation, you take $100,000, that means you take $100,000 divided by 27.5, that equals $3,636.36. So that to me means that $3,600 and change is all that I can offset my tax burden with at the end of the year, right? Is that a good way to look at this? Like 27 and a half years equals $3,600 for every $100,000?
Correct. Yeah. For regular straight line depreciation, that's exactly right.
Yeah. And now what this is allowing you to do as an investor is you can basically ram a lot of this forward into a much shorter time frame where the amount of money that you're using to offset your tax bill is a lot higher than it would be normally. So and I think I did some quick math on this, and it ends up being and I want to defer to you because I feel like I'm getting way out over my skis here, but it's like a 5-year period on a lot of things that are components of buildings. So that ends up being like a 5x or 5.5x multiplier on what you would normally be able to get for depreciation. That's freaking huge. So
yeah, exactly.
I'm going to give you the floor on this. How does this all look in practical terms?
Yeah, so you're exactly right. There's a huge amount of the components of the property that depreciate on a 5-year period. Now, the main value of every property is still going to be on that 27.5-year schedule because that's the structure. So essentially, we're looking at the structure. How cost seg works is the engineers come and break down the different things, and the IRS has already pre-assigned values to certain components. So we just identify what's in each property, what the square footage, what the amount, et cetera. So the building, the structure, that means the roof, the walls, the doors, windows, foundation, all the stuff that's infrastructure, that depreciates on that 27.5-year schedule. And that's always going to be the majority of the value of almost any property. However, there can be sometimes 20 to 30% of the value is going into these faster 5 or 15-year depreciation categories. And it used to be called component depreciation, which makes a lot more sense than cost segregation, because we're just saying, hey, there's furniture, there's appliances, there's carpeting, right? Cabinets, window treatments, fixtures, lighting, all kinds of stuff like that depreciates on this 5-year schedule. So the engineer comes in, identifies and says, okay, this $100,000 property you bought, really 20,000 of that is in the 5-year depreciation category. And so now I can take that $20,000 as a deduction over the first 5 years, which essentially is doubling your cost of your deduction every single year, because if you take 20,000 divided by 5, it's extra 4,000 instead of that 3,600 that you're having in your example of the $100,000 property. So you're doubling your deduction, every year for those first 5 years. However, what happened a few years ago, back in 2017 actually, was there was a new law that was passed called 100% bonus depreciation. And I apologize if I'm skipping ahead. You maybe had that in your question somewhere.
No, please go ahead.
But essentially what bonus depreciation came along and said was that once you do a cost segregation study and have identified those 5 and 15-year components, you can now take 100% of those deductions in the first year. So instead of spreading that out over a 5-year period, you can take that $20,000 as a lump sum in the first year. So like you said, you're more than 5xing your deduction during that first year with the 100% bonus depreciation. Unfortunately, that law, when it was written back in the Tax Cuts and Jobs Act in 2017, it was set in the books to phase out, which has already begun to happen through the end of 2022. If you bought a property between 2018 and through the end of 2022, that 100% bonus depreciation applied. In 2023, it went down to 80%, 2024, 60%, 2025, it will go down to 40%. However, there is some talk about it coming back. I'm not going to get too much into that because right now it's still speculation, but it is very likely that it's going to come back to 100% bonus depreciation. But even the 80%, 60, 40%, that means you're still able to take a big portion of those accelerated deductions in the first year, and then the remaining will still spread over those faster 5 and 15-year periods. So yeah, it's supercharging your, as one of my clients said years ago, it's depreciation on steroids.
So if you're taking the 5-year option on this, and as long as you don't sell the property in the first 5 years, you're not paying any penalties, right?
So you're never going to pay any penalties. I think one of the biggest misnomers or misunderstandings about cost seg and depreciation is something called depreciation recapture tax, which is anytime you sell a property and you have a gain from that sale, you're going to be subject to a certain tax, right? Everyone understands capital gain tax. If you made a profit, you're going to be taxed on that gain. Similarly, depreciation, you're taking this deduction, but the IRS is going to tax you on the back end of the amount of depreciation taken is going to be taxed. Now, there's a couple of things to note about that because you talked about, and going on Bigger Pockets. One of my favorite things about the Bigger Pockets podcast was how so many people got this wrong and misunderstand, depreciation and depreciation recapture, because one of the most common things, and you can go and search it now, right? You don't take my word for it because everything is up there. Like you said, for prosperity, you can go up and see depreciation recapture, and you'll get people saying, why do a costing? You're just going to have to pay it all back when you sell, right? No, you don't. That's not what depreciation recapture means. It doesn't mean you're paying anything back. It means you're going to be taxed. You're going to be subject to a tax on the sale. However, there are many strategies, many types of deferrals or other types of deductions that can help to either offset, defer, or completely eliminate recapture tax upon sale. So I always say this, being subject to a tax is not the same thing as paying the tax legally. There are many ways to kind of get around that. And so the time value of money of cost seg is, how can I use these deductions now and use that to reinvest, use that to make more money, the compound interest that's coming through that, as opposed to not taking those deductions and not having that benefit, and anyways having to pay the recapture on the sale if you do sell. So, I mean, Ted, you talked about if you sell within the first 5 years. Actually, after a 5-year period, once you've done the cost seg, all those 5-year components that you've taken the deduction are actually no longer subject to recapture tax because the 5 years have passed.
Right? They're worthless.
From a tax perspective, they have no more value, and so you don't have to pay that recapture tax. It's not an automatic thing, but it's something that that you can fill a form to make sure that you don't get hit with that.
I'm glad you brought that part of it up. One thing that I did not have a good understanding of when I first started looking into the possibility of doing a cost seg study, I thought that if you took 100% bonus depreciation, like if you rammed forward all of the depreciation that you could take into either the first year or maybe it's spread over 5, doesn't matter. I thought that was it. Like after that, like you're done. Like this property is 100% depreciated. You can't do anything moving forward. So you're just kind of taking it all in year one. And then you're like, man, you really got to be smart about when you time this, because, if you need write-offs in other years, you're kind of hosed. And then I since then learned that, well, yeah, after you get to past certain thresholds, then you're putting in new carpet, you're putting in new stuff, and then you can depreciate those things over again, right?
Right, exactly. And that's how, it's the principle is based upon, right? That why there's certain things in the property that depreciate faster is because the typical way is to replace certain things over a faster period of time, or they wear out. But again, it's important to keep this in mind. The whole concept of depreciation and cost seg, it's all theoretical, meaning it's all in a borrowed term, because it's not based on the actual useful life of those components or the property. It's based on your personal, subjective to you, because depreciation starts when you buy the property. So let's say you go out and buy a multifamily property, right? That was built in, 1975. And you go and it's the last time it was renovated was, let's say 5 years ago, right? So if you go in there, all of those appliances, and the previous owner did a cost seg, right? And he bought the property for $5 million. You come in, 5 years later and buy the property for $6 million. You're now going to be able to start that depreciation schedule, the 27 and a half years, starts over now when you buy the property. And it's based on you and your $6 million.
I never thought of it that way, but that is a really good highlight to put on this. It's not the carpet. It's not the doors. It's not the whatever. You are functioning within a purchase now where those are considered. Yeah, like I get it. Like, because there's useful life for them, but if somebody else bought them and they did a cost seg study, that doesn't mean you can't do one too midway through, right?
It starts over when you buy the property. So you can now go ahead and do a cost seg and say all this, carpeting that was put in 5 years ago starts now. And so now I can depreciate over a new 5 year period. And so again, it's totally subjective to you as the owner.
Oh, and if you got a building you want to sell me, go ahead and sell it to me and I'll sell it back to you maybe a year or two.
We just do it, yeah. L1031 and then yeah.
I got you.
So what let's do this. What is a quick and dirty litmus test on whether or not a property could qualify for a cost segregation study? Like, I know you have probably a lot of calls like this. So what's kind of the quick version of this where you have a cheat code?
Sure. So first and foremost, any type of property, right? Any type of property whatsoever. It doesn't matter if it's single family, multifamily, storage, office, industrial, retail, you name it. Anything is eligible to do a cost seg on. And the bare minimum I usually like to look at, although we'll even look lower, but I say my rule of thumb is like any property purchased for over $200,000 is worthwhile to look into doing cost seg, which people think, like, what do you mean 200,000? I thought it was like 2 million or 5 million or 10 million or something, right? And so that's another huge misconception about cost seg is that it's only worth it for like huge commercial properties. The third biggest misconception is how much it actually costs to do a cost seg. There's an article going around from the Journal of Accountancy from like 2005, right? Which I've seen literally quoted in blog posts, kind of linked to this, thing. And I've corrected people on this, that it says in this article, again, from the Journal of Accountancy in 2005, that says, cost segs are only really worth it for large commercial properties because it can cost up, somewhere, in the range of $30,000, $40,000, $50,000 to get something like this done. Now, that may have been the case 20 years ago. However, it's not the case today, right? Today, and we're Madison Spectra, the biggest national company doing this. We're, doing volume, twice as much as the next competitor out there. So we're doing, 10,000 studies a year. And, we're averaging about $5,000 to $6,000 for a study, which is very reasonable. If you're buying a $5 million, $1 million property and you're getting a $200,000, $300,000 tax benefit, that's incredible. So again, going back to your question, what's the litmus test? $200,000 starting point. And we always like to run a free estimate beforehand. So you can actually see specific to your property what the potential tax benefits are going to be even before, getting it done.
That's funny you mentioned that because the first and second time I heard about this was local meetups where somebody came and talked about this topic. And the first time they're like, hey, it's multifamily only, $1 million minimum. And maybe that was
I had always heard $1 million minimum, and that was always what was in my head. Like I heard that from somebody, and it got reinforced by more people.
And then the next meetup, it was like 500,000. Yes, can be a single family, and that like completely blew my mind because I'm like, well, that's not what I've known over the last 3 years. And this is the first time I've ever heard anybody say, hey, you got a Airbnb or short-term rental or mid-term rental, or you got something that's $200,000 or more, then you should probably look into this. It excites me because my portfolio is mainly Airbnbs that are, small single families.
Yeah, absolutely. And it could be that part of this is going back to what we were talking about earlier about like bigger pockets and stuff, having things up there forever. When people talk about this, they just repeat, what others have said. And so that may have been the case. And the truth of the matter is, before the 100% bonus depreciation, we were really only pushing it, for like, $500,000 or $1 million properties and above, because that's what made the most sense, because you didn't have the bonus depreciation. Once the bonus depreciation got introduced, it made it a completely different ballgame and made it much more accessible for even smaller property owners.
This is such a complicated topic, and I know I'm trying to get to the simplification of this, but if you're catching this episode and you're a real estate investor and you're like, I wonder if a property or properties that I either just purchased or maybe recently purchased would be a good fit for this. This is, by the way, all news to me, and I've done several of these cost segregation studies. So
It's like golden nugget drop after golden nugget drop.
It really is. I mean, I'm sure there are people catching this episode that have done way more than I have, but I would bet you there's a lot that haven't done anywhere close to a small handful. So you said 200,000 is probably, and I know there's some variability in this, but 200K is probably the break even where it makes sense, or maybe not the break even, but you should still do it if it's 200K under certain circumstances. Are there any other things that are good to think about where you're like, should I or should I not spend the time to call Yonah or his company and see if this is worthwhile doing? I bet there's a lot of people that are asking that question right now.
Yeah, I mean, and there's a lot of questions I'm sure people have listening to this, and it always happens when I get on podcasts that people call up with follow-up questions. And by the way, it's always worth the time, right? It never hurts to ask questions. And I have available, publicly available, my Calendly link. People can schedule, free 15-minute consultations with me. So feel free to...
I'll put that in the show notes too.
Yeah, if you'll check that out. Again, there's always questions that come up, and I'm happy to discuss, happy to answer. But some of the other things really to point out, number one is if you are a real estate professional, again, that's one of the biggest concerns. If you're not a real estate professional, which means either you or your spouse are not full-time in the real estate business, then you're limited to use depreciation, unfortunately, only to offset your passive or your rental income, which is a little bit of a damper on the party for a lot of people, especially who just watch YouTube videos and see like people talking about, do a cost seg, can never pay taxes again, and stuff, right? No, unfortunately, that's not always the case.
Little pop-up balloons happening every while you're talking, right?
We'll put one right here, while we're talking here, Phil.
Like the old school Batman.
The other thing to think about is how long you're holding the property for. Ted, you talk about for a 5-year period. Yep. If you're planning on selling a property within the first year or so, then it's probably not worthwhile to do the cost seg. There are certain cases where it still is, but usually not, simply because you do have that recapture tax on the sale. And even though there are ways to kind of avoid that or defer that, the time value of money is going to be much less. And so it usually doesn't make sense to do it on a short-term hold.
I feel like I really missed the ball in here because I have a 5-unit Airbnb. It's worth $500,000. Mm-hmm. And I feel like I really missed it because I have this listed for sale right now. I wish this was a conversation that we would have had on a podcast 2 or 3 years ago.
Well, 2 really good, important, more nuggets that I'm about to drop that related to what you're talking about there is, number one, you don't have to do the cost seg in the first year of ownership. You can do a cost seg at any point, right? Which means if you bought a property 5 years ago, you can do the cost seg now and take that for this year's taxes. The other important thing is that even if you have something listed for sale, if you didn't yet file your taxes for 2024, you can still do the cost seg and get this tax deductions for 2024. However, right, you're going to have that recapture tax right on the sale the next year. So it's a question of, always the strategy. Do I have a big tax bill this year that I want to offset? And, what's going to be my situation next year? And again, to discuss that with your CPA and figure out what the best strategy for you is.
This episode is brought to you by JM Real Estate Capital.
Hi, it's Rob, JM Real Estate Capital. We're the money guys that you need to know for all your real estate investments. Talk to us. We can do what your local bank can't or won't do. We don't have millions. We have trillions with a T to lend. 844 we close, or go online, jmrecapital.com. That's jmrecapital.com. JM Real Estate Capital, smart solutions for the real estate investor.
Yonah, here's something that somebody catching this episode on, say, December 4th might be wondering. How quickly can you churn these bad boys out? Because if they want to do a cost segregation, they're like, oh my God, I had no idea of any of this. I do it before the end of the year.
Great point.
What's a realistic time frame? And then like, hey, I really need this right now.
Yeah, exactly. Exactly. Yeah.
How much more does it cost?
Exactly. So one of the most common questions I get this time of year is exactly that. And you do not need to have the cost seg done before the end of the calendar year. Right? The cost seg itself, as long as it's done before you file your taxes, whenever that is, if it's March 15th, April 15th, or even if you're on extension to September, October 15th, that's when you need to have the cost seg completed for that tax year. So yeah, even if you're listening this December, still plenty of time to get the cost seg done. Practically speaking, it does usually take us about 3 to 4 weeks to complete the cost seg once you do engage with us. Like I said, that free estimate takes about a day or so just for you to know ahead of time. And then, the expedited fee, there is something, it definitely happens every year, every tax season. We have someone call up, literally like March 10th. I need this for the March 15th filing. Can you get it done? We get it done. We try to get it done every single time. So yeah, I mean, to get it done, we have a huge team. And so that's part of the benefit, that we can kind of push things to the top of the pile for certain people. Yeah.
Well, I will certainly, I will vouch as a personal customer, and I'm not, by the way, I'm trying not to brown nose too bad here, but I really have always appreciated the turnaround time, the thoughtfulness, the questions asked. And I never felt, even though I didn't fully understand what was going on, you guys did a good job of explaining it. Just, I have a 10% absorption rate for this kind of stuff. And that's really all I want, honestly. Like, I don't want to walk around knowing everything about cost segs, because I won't have room for the other stuff, which is, I don't know what that is, fantasy baseball and whatever. But I will say, personal testimony, like I had a conversation. I'm trying to remember my first one. I had a conversation with one of my business partners, Chris Pomerlew, who I believe, I don't know if that name rings a bell,
Yeah,
but
of course.
there's not many Pomerlews out there.
Omaha, yeah, in the house, absolutely.
Yeah. So we bought a property together, and we were talking about our tax situation, like our just personally, right? And we were on a call, and I happened to mention in this, and there were like 4 or 5 of us on a call, and I happened to mention, I'm like, oh man, this year's really going to suck. I have a couple properties that are selling, and I'm going to have a huge tax hit. I'm going to owe like probably a couple $100,000 in taxes, just because, I'd owned them for a while. They'd appreciated in value and so forth. And I was like, this is going to blow. So the call went on, we hung up. He calls me like 5 minutes later, and he's like, hey, just wanted to like have this convo with you offline. And he's like, what are you doing? Because I'm like, what do you mean, man? I was like, because here's where I was going with this. I was like, if I sell this one, I'm going to have to do a 1031 exchange. Otherwise, I'm going to owe like a boatload of taxes on it. And that's going to really suck, and this and that. And he goes, Chris and Colin Schwartz, who have both been on here before, they syndicate and they buy a lot of multifamily assets, and they're usually, fairly larger assets. So they do a fair number of these cost segregation studies. And he's like, no, if you're continuously buying, just do enough cost segregation studies that it will offset all of the capital gains taxes that you would have from selling that. And I'm like, right. I knew that. Yeah. So then I felt honestly really dumb, because I've been investing in real estate since 2005. So this I'm only highlighting this because this just goes to show that you don't know what you don't know a lot of times. And if you're catching this episode and this sounds in any way, shape, or form like it might benefit you, you should absolutely click on the Calendly link and do a 15-minute discovery call, because that's exactly what I did. And I'll tell you what, I did not pay much, if anything, in taxes that year, when I thought I was going to have like a huge, heavy burden on that. So kudos to you. And he wouldn't have even told me about that if you guys hadn't have done a good job with it. So that's my point to this, is like, you're getting evangelized out there by a lot of people other than just your own efforts through podcasts and Bigger Pockets random posts. So
for sure,
it affected me personally, and I'm in a much better financial situation than I would have been otherwise. I'm about to cry.
We all are.
I think it was actually Chris Pomerlew that first told me about this.
Oh yeah,
to be fully honest with you.
There you go.
I don't remember the conversation specifically, but I remember him telling me about it. I'm like, what are you talking about? It was so above me.
Yeah. Well, okay, Yonah, in the interest of getting you out of here in time to enjoy the Thanksgiving, what do they celebrate Thanksgiving in Jerusalem? They probably don't.
We have Thanksgiving every day. That's the truth.
Yes. I love it.
Yes. But no, I mean, obviously it's the American holiday, the Pilgrims and Indians, or whatever you want to call it, the tradition there. But no, we don't really celebrate much here.
Okay,
it's actually my top 3 places to visit. I want Jerusalem and Egypt are right there on top 2.
Oh, cool. He'll be your tour guide. I was curious. This just came to me, but do you know by chance, do any other countries around the world participate in a similar type of tax friendly type of a real estate structure with as cost segregation studies? Or is that
as far as I know, no. I think there are many other countries that do have depreciation, but the idea of cost segregation, I don't think it exists. As far as my knowledge, and I'm very happy to learn more about it, but I've done a little bit of research on it and haven't come up with anything. Canada has like something somewhat similar, but it's more like write-offs and things like that, like certain similar to like the 179 deduction that we have, which certain equipment and stuff like that you can fully write off in the first year, but they don't have anything like cost seg.
That's their little exemption in the tax code. Okay, I've been really curious about this. So we have a section that we in this podcast call
Failing Forward.
This Failing Forward is brought to you by PropStream.
PropStream is one of the most trusted real estate data software solutions. PropStream benefits all real estate professionals. You can find properties and contact homeowners on the go with PropStream's mobile app. We offer free academy courses tailored to real estate investors and agents. Take advantage of our live webinar demos to learn the software and scale your real estate business. Visit www.propstream.com and sign up for your 7-day free trial to get more leads and grow your business.
It's called Failing Forward. And in this section, we always ask, like, has there been anything that hasn't gone well that you maybe have learned some lessons along the way that you could share with listeners?
There's always things, we're always learning lessons along the way. One thing quickly that I'll share is a story about, sometimes, especially starting out when you're in sales or in business, you go after like the big elephants, you want to get like the big whales, as one of my friend Jerome Myers likes to call it. You go after the Moby Dick, right? He said, don't do it. Go get the little fish, go after the little ones, the deals. You do much better that way. Now, most young brokers or young people getting started, they have big, bright eyes and they want to go after the biggest things. Unfortunately, sometimes they don't work out and you end up missing out a lot of wasted time doing that, but also you get caught up in the emotion of it. It's like, oh, this is the best one. So I'm bringing that up as a story that I had someone reach out to me once. This was years ago, where he had a portfolio of 26 shopping malls. Okay, so I'm talking, this is like malls, like 300, 400, 600,000 square foot shopping malls across the country. Yeah. And he's like, yeah, I've never done a cost seg. I want to do cost seg on all of them, And so I get like on a conference call with him and one of the CPAs on my team, and we're talking through it. And one of the first things he says is, how much does it cost? And so like, okay, we're, quote, these are huge, huge projects. We gave him a price. He's like, no, that's way too much. It's like, I'll do it for, X amount. And he threw out like a number about half that amount. The first conversation we have about it, like he's in there negotiating the price. And I had a gut feeling at the time that something was a little bit off and maybe I just shouldn't pursue this. But I was like, this was huge, one of the biggest deals of the year, right? This is going to come through.
Yep.
Now, one of my colleagues who I was discussing the thing with, he's like, if the guy's arguing about price, and this guy had been, in the business for a decade, and someone who really had a good head on his shoulders, said, if the guy's arguing about price right from the beginning, he's probably not going to end up paying. That's what he said. And it was like prophecy. It was like prophetic, because this guy ended up being a nightmare of a client. I mean, literally, like everything that everything could do. And I'm not going to get into the whole story, but in the end of the day, he kept changing it. No, I don't want to do 26. I'm going to do 21. Okay, not 21. I'm going to do 17. Okay, then at the end of the day, we ended up doing 3. Okay. And not only this, he was one of those guys that before the September 15th tax deadline calls up with his attorney and CPA on a conference call. And like, we want to get this done, for the September. It was like a week before. He's like, we want to get this done. I'm like, what happened the last like 4 months? We're on these back and forth calls. You're not answering phone calls. At the end of the day, we ended up doing 3. Okay. He didn't pay for them. Okay. Literally, he never paid. I back and forth and phone calls. I don't want to pay. I literally drove to his office. Okay. Not from Jerusalem, but I come to the States probably 5-6 times a year, but he was in New York, and I drove, about an hour or so to his office to literally have him hand me a check, a physical check, because the guy literally hadn't paid. It was a nightmare. And that was, I think, failing forward was the biggest lesson that I learned from that, and many lessons along the way. What the biggest thing is, sometimes the biggest deals you think you get really excited about, but you have to go with that gut feeling. Okay. That gut feeling really at the beginning, which was like, something seems a little bit off here. It's usually the right move.
So I had a conversation real recently, actually, about cognitive dissonance with a business partner, friend of mine, where I've really started to trust that more and more over the years, where you meet somebody and something just seems off when they're talking. Now, maybe they're on drugs, or maybe you are. So there's also that. But let's say everything's normal, and they are just something seems off. You can't put your finger on it. The way they're talking, like the way their mannerisms are, like something is off. Like I have really started to dial into that, and I have ignored it at my own peril multiple times, and now it's been a glaring example in my life. So I've had that exact same situation come up, although I that's how I frame it now, is like cognitive dissonance when I meet somebody, even if it's not a business relationship, it's just somebody I'm meeting, and I'm like, man, they got weird vibes, man. You know what I mean? Whatever that is.
Yeah. Unfortunately, in America today, that's like half the people you meet, you know?
I feel like we had a deep point. Did we have a deep conversation on this twice in taxi rides in the last couple of days?
Probably. Yeah.
Yes. Okay.
You were that guy.
Yeah.
By the way, I was trying to leave you nameless, but it was Ted. Anyway, so no, that's really interesting, and I think back to when I was in like financial planning. So I would, you eat what you kill. So you're going out meeting with hopefully higher net worth individuals, but in the beginning, it's just kind of like friends and family and whoever will take an appointment with you and let you sell them a $50 life insurance policy or whatever. But after a while, I started meeting and having all these regular appointments with people. And then after a while, and you got them as clients, the things that I ignored when I was meeting with them are the things that magnified later.
Yep.
In how annoying they were, or how difficult to work with, or whatever. So I like that you brought that up, because that's a really recent topic that I've dug into unknowingly with Ted.
It's interesting though, because sometimes you just have a feeling, and you just trust your heart and soul that person's good or bad, and you do or don't want to be. I mean, you got to just listen to yourself, right?
And listen to, the mentor or the outside person. Like I said, I had that colleague that kind of put that right at the beginning. He validated my gut feeling, but I chose to ignore it that time. And so that's also the benefit of having a mentor, or having friends, or people that are kind of that outside objective perspective.
Yonah, one thing I was reading on, is it true that you have 6 children?
It is true.
Man, how do you manage that, doing the business, doing the podcast? I mean, we had 2 kids and we feel like our life's crazy, but with 6 kids, I mean, what's the age gap there?
It's pretty crazy. I'll be honest, it was much harder during the earlier years. My youngest just turned 10.
Yep.
And my oldest is 20. So they're about 2 years apart each. They were a handful. So in the first 10 years, it was definitely a handful. As they get older, each one helps out. They do things, they help each other. But they're all amazing in their own special way. So I love it. I wouldn't change it for a minute.
Do they travel with you also?
No. That's when I get to get away. You know what I mean? I get to take some time off.
That's your break.
I love it. So we have one more section of this podcast that we lovingly call the
OT with Owen and Ted.
You're going to get OT with Owen and Ted, presented by Magic Door.
Magic Door is the AI-powered property management platform designed to handle everything from the rent cycle to the vacancy and maintenance cycles. During the rent cycle, Magic Door collects rent, sends automatic reminders, deducts management fees, and distributes payments to owners. In the vacancy cycle, Magic Door streamlines listings, tenant applications, seamless multi-language communication, screening tenants, and converting applications into leases with one click. And for the maintenance cycle, Magic Door's AI handles everything, asking tenants key questions, assigning tasks to vendors, and scheduling repairs automatically without you getting involved. With no hidden fees, no onboarding costs, and seamless AI-powered automation, Magic Door takes care of the entire property management lifecycle so you can focus on what matters most.
Where we've got the same questions that
sometimes
slight variations.
Sometimes we
ask every guest. And the first one I've got for you, Yonah, is, where is the book, bro? I feel like you've got a book. If anybody I've ever interviewed on this podcast has a book in them, it is you. Is this coming or what? When can we expect it, and what's it called?
Wow.
And it better be about cost segregation studies. You're like Bird Watching by Yonah Weiss.
Right, exactly.
Maintaining the perfect beard.
That, that's something that it just comes naturally. I don't know, but no, the goat herding for beginners. No, the thing, cost seg it's like a no brainer to make a book about that. And I think with the help of AI nowadays, I could probably put it together and have someone else do it for me and kind of just take all the recordings of different podcasts I've done and just put together a book from that. So I think that's something that definitely should be done, to be honest. So that's an easy one.
You literally could upload just all the transcripts.
I mean, that's going to be a lot of work and sifting through it all. But yeah, there's definitely a book in there.
I love that.
Cost seg for dummies. I don't know what we'll call it.
And by the way, Yonah, I think that you now have won the beard contest because the Beardy Brandon was probably the person that had it before, but I have a feeling yours is a little bit longer than his.
Yo, it is. It is. When we actually,
fuller. I think yours is a little longer. So
it is. Yeah, mine's a little full. Yeah, his is very bushy. Mine's definitely longer. We had, when he was a guest on my podcast years ago, we had the beard off. We had a beard competition.
Beard off.
Yeah.
How long have you been growing that?
I mean, I haven't cut it. I don't trim it for religious reasons, but basically since it started growing. So like, I don't know, 20 or so when it was really started growing in.
My kids always ask me like, how long would it take you to grow it down to your waist, Dad? And the longest it's ever been is probably about 3 or 4 inches. And I'm like,
I can't do it.
20 years, but obviously 20 years doesn't get it done.
Dude, I hit 2 weeks and I can't get past the 2 week barrier. Like it just starts like driving me crazy and itching. And like when you smile, it like pokes you in weird places or in your face. I just can't. I hate mad respect though for you guys that can pull it off. I can't.
I love that. Hey, if you could interview anyone in the world today on your podcast, who would it be? And what's the one question you'd like to ask them?
So, I'm a big fan of Gary Vaynerchuk's work. He was one of the first people that I came across when I started using social media and using that as a business forum, and really blew me away. A lot of paradigm shifts with how to use social media, how to sell through teaching and things like that. And so one of the things that I would, love to ask him is, just about how to kind of make the brand grow in the way that he's blown up, and he blows up brands. Like that's his specialty. But I've kind of found my niche and really honed it down. But to be honest, over the past year or so, it's kind of stagnated. I wouldn't say stagnated, but it's not growing with the snowball effect that was previously. So I'm just kind of seeing if there's a way to do that.
It's growing like a 20-year-old beard, right? At this point.
Hey, Yonah, what about in your personal life outside business? Who's the one person you like to have on there?
To be honest, there are so many people. The CEO of Madison, who's the founder of the company, really amazing guy. I'd actually have asked him to be a guest on my podcast, but he's so busy. Just an incredible person. His name's Joseph Rosenbaum. He's not just as a business person, very, very sharp business mind, but as a philanthropist, he's incredible. I mean, he does so much and helps so many people in so many ways and in a very discreet way. Like he'll do things that nobody knows about. And that's what I love. And so those one of the things I would love to be mentored on further is that, because that's something I'm very passionate as well, is helping and finding ways to give back.
I love that.
I love that too. That's good stuff. All right. This is moving into bad stuff with your funeral. And we've got somebody walking up to the podium to give your eulogy. Who's going to be? What do you think they're going to say about you?
Well, I would hope, I'd love for my kids to do that. I hope that they have the perspective that in life that I'm giving them. That's something that's powerful to me. Make sure to give over to them everything that I'm kind of living by, what I hold to be true to myself. Hopefully I'm living that enough that it just comes across to them. So I'd keep it simple with that.
I mean, they got to be really aware of everything that you're doing. I mean,
not really to a certain extent, but I mean, I don't talk to them too much about business and about things like that. Like they know they have the podcast, they have their Weiss Advice socks, they love those, but
I remember the first time my daughter heard me like with a REIA Radio podcast on in the back, or like she got in the truck, I was taking her to school or something, and I hit play on that. She just looked at me like, bro. Are you kidding me right now? Like I was like, okay, turn that off. Like I was like, I thought you were still at the age where that might be kind of cool. Like, Dad, you're on the radio. That's what I was going for. She's like, oh my, I thought she was gonna freak out and be like, oh my gosh, you're like that. I'm gonna tell my friends. She's just like, dude, are you kidding me? What are you doing? Lame. So that ship has sailed a long time ago. My kids do not think I'm cool at all.
This is what you do. You just turn it on when you know you're going to talk about the kids, so they hear you talking about them, and that's game changing right there. Because if I know I'm going to mention Skylar or Carson, I have it on, and then they get super excited about that.
So I did try that one time, and then my oldest is like, "Do not talk about me again." She's 16 now, so this is
that's the age for sure.
Yeah, she's just like, do not ever do that again. So
was this the episode? Was this the episode we talked about driving for the first time?
No. But I'm just saying, dude, you just wait, man, until their age has a teen or like that behind it. Like
my kids love listening to it. That's why
I'm just saying.
That's why I watch everything I say.
It's coming, man. Like it's coming where they're not gonna want to hear anything about you.
Oh, jeez. I'm just gonna think that they love me and they're always gonna want to know everything about me. So, but. Yonah, what mentor in your life has had the biggest impact on you, and how have they influenced your career or personal growth?
I'm going to shout out a good friend of mine. I wouldn't, he was definitely a mentor of sorts, not like an official coach or anything like that, but he was the first one to kind of get me involved in real estate. Yeah. And it was at a point in my life, and if you've listened to other podcasts, I've talked about this a lot in previous podcasts, where I just needed a change. I needed something different. I was teaching and had some major financial burdens, had a health crisis in my family that just kind of put me back. And I decided to do something else. I reached out to a bunch of people. Real estate kept coming up in conversation. And then I met this friend, David, in the parking lot one day. And I was just like, hey, I'm thinking of doing something in real estate. I know you do something in real estate, but I don't really know what it is. And he was like, yeah, he was a commercial mortgage broker at the time. He also owned a few multifamily properties and managed them on his own. And he was like, yeah, just come and work with me. Like, come and sit in my office. And that's literally what I did for like 8 months. I went every day for a couple hours, just sat in his office and did some cold calls and learned everything about commercial mortgages and real estate. And it was incredible. So it was more from, apprenticing, so to speak, as a mentorship, which is that. I love that. And if you can do that, if you can find someone who's ahead of you in whatever it is that you want to do and just apprentice them, just hang out with them. And while they're doing what they're doing, and you'll pick up so much just from the osmosis and just from being around them.
At what point did you become a celebrity in cost seg studies? Was there like a moment that something happened? I mean, there had to have been. Like, did something go viral or what happened?
Yeah, I mean, nothing really went viral per se, but back, I think 6-7 years ago, LinkedIn was really, BiggerPockets was very helpful, and LinkedIn, really the only two social media platforms I was using at all. And LinkedIn at that time had just really taken off as like social media. Before that, it was more just, put your resume and find jobs and stuff like that. And so there was this space and nobody was talking about it. Nobody was doing anything. And there were no podcasts out there almost at all about costing. And I just started getting on the podcast circuit, just literally by word of mouth, one by one, and then using the social media to post about that. And every time I would post about a podcast, more people would ask me to be a guest on their podcast. And it was like this Joe Fairless kind of phenomenon where he was telling all of his people, everyone has to have a thought leadership platform, and you have to have a podcast. So everyone's getting a podcast, and I was the only one out there with the name doing anything about cost seg. And I was the only one who was talking about it in a way that people could understand and relate to. And so it literally just snowballed from there. And so I think it was probably like 6 months to a year or so. It just really took off. People coined me the cost seg king, and I just took that hashtag and ran with it.
Do you find yourself being recognized now in airports outside of real estate conventions?
No. Although I've run into people, it's definitely happened in different places. But at the real estate conventions, that's really where I'm the celebrity. So it is limited to that, but I'll take it.
Was it Sarah Weaver? We got pretty deep about that, and we were talking about. She's like, "Yeah, at the conventions, I feel like I'm like the biggest deal ever." But then then I'm in my regular life, and I'm anybody.
Well, the thing is, like you are brandable with your look, right? So it's like Beardy Brandon, and then you got Yonah. He's got
I stand out.
Yeah, like so you got the tatty investor Megan Ahern. She's got tattoos, so you got to be exceptional in that. Not like the 50-year-old regular looking dude that's got rifles. Yeah, like we got to work on our brand, man. I think that's our problem. So
I love this.
So Yonah, are you guys looking for more customers right now over this is a stat for you, and I don't know if this is old, it might be, but am I right in understanding that you guys have done over 30,000 cost segregation studies?
Wow.
And $3 billion with a B of actual tax savings to your customers? I just want to bring that up because those are big stats.
Yeah, I mean, that was a correct stat. I'm not sure how long ago. I haven't looked at the updated number, but it's certainly more than that since whenever that number came up. It's probably well over 4 billion at this point. So
you're good now then. You don't need any more.
Yeah, exactly. Right. No, the more people I can help, the better.
Yeah, this is amazing. So anybody catching this episode that and you should be, by the way, like if you're in investing in real estate in any type of capacity where you're buying something that's 200 grand or more, you need to do yourself a favor and click on the Calendly link, or at least read up on Yonah and his group, Madison Specs, on what they can do for you or what they can potentially do for you, because this can be game changing and life changing out of that. And I'm speaking from personal experience here. So make sure and you look up the show notes on this and click on that if you want a further consult, not insult. I was going to say insult. That's my job.
Yeah, you are the insulter.
Whatever. So there we go.
Yonah, I just want to give you a shout out because you and I have communicated. You always respond to your messages. I think that's just the type of person you are. The big heart, hey, I got my parameters, I got my rules and how I do things, but I'm always here to help. And I appreciate that about you. So thank you so much. I've never got the chance to physically meet you in person, but I have seen you at a couple Bigger Pockets events. And but you had that stardom going on, and you had a big crowd around you. So, but thank you for coming on today. I really appreciate it. I want to sign off with one last question before I give it over here to Owen. But if you could suggest one person for the REIA Radio podcast, who would it be?
Ooh, you know what? What I'm going to do, because there's so many people, I can't really.
I've never asked anybody that question.
What I'm going to do, I'm just going to open my LinkedIn, and the first person I see, that's who I'm going to suggest, because I could suggest anyone, but I'm just going to let fate take its course over here.
We did that in Vegas all week.
Oh yeah.
Yeah.
Okay, we got Bob Knackle. You know Bob Knackle?
I don't. Who's Bob Knackle?
Bob Knackle, Knakal, is the most successful real estate broker in New York City of all time.
Okay.
Yeah, talking about 4 billion. He's sold over 4 billion in real estate in New York City. Incredible guy. I've actually met him a few times. Just an incredible personality. You can look him up on LinkedIn or on Twitter. Very active there. But he's got the Knackle Nuggets, he calls it, with the K at the beginning, and all kinds of stuff. Very successful. So many things about him. You can learn so much about him just from his profile. I mean, he's been doing it for 40 years basically in real estate, and just an incredible guy. And he's like an expert in a lot of things. He's an expert on Seinfeld. And when I had him on my podcast, I did a whole segment of asking him, trying to stump him with Seinfeld trivia, and he literally blew it away. It was crazy.
We need to find a Seinfeld specialist to bring in.
Well, you know how, like, if you're on Instagram or whatever, I know you're an IG pro over there. If you're on that, it'll feed you more of what you're looking at. So, like, I for some reason fell into this loop of looking at Seinfeld bloopers. So now, like, a third of my feed and Instagram is all Seinfeld bloopers, and they're hilarious. And I keep watching them. I don't know why, but like that's. So I feel like I could be up there. Maybe now, I'm not Bob Knackle territory, but I think I could compete at least. That's top 10.
That's a good feature question for the OT.
Is it?
Yeah, because like mine right now is all on building the pyramids. I got stuck in a couple videos, and I'm just now all I see is that.
Yeah, that's weird.
It is what it is. Well, with that, Yonah, Owen Dashner, will you see us out?
On behalf of REIA Radio, Aiden Bear, and Ted Kosh, I'm Owen Dashner. You've been listening to Yonah, the shepherd of cost segregation studies. Weiss.
Sign off.
Weiss advice.